Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Compared to developed countries, emerging markets have rarely looked cheaper. With valuations, economic growth, and demographic trends in their favour, is now the time to invest.
Or could climate change, protectionism, and debt hold them back? And in today's dumb question of the week, is South Korea an emerging market? Okay, let's get into it. So right now, the valuation gap between emerging markets and developed markets is at about its widest level in 20 years. And that's when you look at the forward price to earnings ratio. And I saw a piece in the Wall Street Journal a couple of weeks back called "Emerging Market Stocks Have Rarely Been So Hated. Is it time to buy?" Now, I don't know if that's a contrarian signal or what, Roman.
Yeah, and right at the outset, I think it pays to look at what we mean by an emerging market, because I think it's a pretty odd term in today's world, because it covers countries like China, for example, a huge developing economy, which is in many ways more advanced technologically than some economies in the West now. And then you've got India, which is a huge democracy, has a population larger than China. And then you've got a huge number of small countries, which are also classed as EM, countries like Malaysia, the Philippines, which are very different to those huge juggernauts of China and India. So I think it's very odd as a term, and it's becoming less relevant over time.
And you've also got a group of countries in the Middle East, like Saudi Arabia, and then you've got Brazil, you've got commodity exporters. Yeah, it's a mixed bag of countries. But then I guess you could say the same about developed markets.
Yeah, that's right. I mean, it's vastly different if you look at a small European country and compare that with the United States, which is also classed as developed markets. So I think with that in mind, if you look at emerging markets right now and look at the two big beasts, which is China and India, they've clearly chosen very different paths. And I think it is a matter of choice that China has repeatedly sabotaged its own stock market and paid the price. So that's hugely underperforming. Whereas India has more business-friendly policies, I'd say, and that's surged upwards in terms of equity performance over the last year or so.
And you're right that they are the two big beasts of the emerging market indices. So if you look at MSCI's emerging market index, China's around 27%, India's around 20%. And in fact, if you group up China, India, Taiwan, and South Korea, that's 75% of the index in just those four countries.
So very concentrated. And I think if you buy an EM index nowadays, you are buying this kind of grab bag of very different countries, which I think is problematic because you're buying two things which are very different, and you may want to focus on one or the other.
And I know that in fact now you can buy an EMX China fund, because I think when you look at all the EM countries, China is the one that's most different to the others. You know, it's the second largest economy in the world and arguably the most important economy in the world in some respects.
And there are some indices, for example, I've spoken to Perth Toll and I did an interview with her, which I shared purely for our members. We didn't put it onto the YouTube channel, but she was really interesting. What she's done is she creates something called the freedom indices, which exclude countries which don't score highly on certain freedoms for their population. And China is just excluded from that index.
So is India.
Yes, and India is as well.
Which was surprising when I looked at it. And do you know why when I looked into it? Because it was originally in that freedom indices and then got booted out. Is because they have too many trade restrictions. That's why it got kicked out. But it is right on the verge. So the index is, I think, the top 10 emerging markets in terms of their freedom score. And India is always around that borderline. So it kind of goes in and out.
So it's just about getting there. But look, they're not going to change their policy based on some kind of freedom index. So I think they'll always be on the verge of being booted out. But it is interesting to look at that index because why not? Why not choose countries based on their democratic principles, the freedoms, the rule of law in their country?
Yeah, it sounds nice, but does it outperform? That's why or why not, Roman? We're cold hard investors here.
Well, excluding China was a smart move when it came to returns, but excluding India, not so much.
Well, you mentioned returns, so let's look at that. Because the reason the valuation gap has grown, I guess, is because emerging markets over the last 5 years, over the last 10 years and longer, have dramatically underperformed developed markets, particularly the US. So if you look over the last 5 years, the MSCI World Index, which is the developed markets, has returned 12.42% per year, whereas the MSCI Emerging Markets Indices has returned just 3.2%. That's a huge, huge gap before you even think about the compounding effect.
Yeah, it also pays to look at the longer term returns. So on the fact sheet that you get for these MSCI indices, it has also an annualized return going back to 2000, the end of 2000. And since then, emerging markets have returned 7.6% versus 6.7 for MSCI ACWI, which is the entire world, and for developed markets, 6.8. So 7.6 versus 6.8 for developed. So there has been an outperformance long term.
It's really interesting, though. I've got a graph which goes back to 95 and looks at this outperformance or underperformance. And you can group it up into 3 distinct time periods. So from 95 to 2000, developed markets outperformed significantly. Then we got the dot-com bubble. And from 2000 to around 2010, emerging markets massively beat developed markets. And then since 2010, it's been all about the US and I guess developed markets in general.
So I think that's interesting because it shows that sometimes you get a kind of self-imposed underperformance from developed markets because they build up a big financial bubble, then they underperform due to some kind of crisis. So it was a combination of the GFC and the dot-com bubble, I think, which made them underperform.
And I think it pays to understand what you're buying when you buy an EM fund. So we've already mentioned how it's dominated by China, India, and to a lesser extent, Taiwan and Korea. But it is very much dominated by Asia. Around 80% of the index is in Asia. And it is very concentrated in a handful of stocks, like most indices are now. So TSMC, which is Taiwan Semiconductor, makes up around 10% of the index, just in that one company.
Yeah, so an incredibly concentrated market. And this is another problem with EM, which is if you do buy an index that tracks a single country in EM, it's usually hugely concentrated in one sector or even in one stock. The country which really stands out as being different there is India, where financials dominate, but it's not dominated by a single stock or a single sector disproportionately, I wouldn't say. So financials make up about 20%, and other than that, it's got a nice sector composition, which is quite diversified.
But if we look at EM as a whole and compare the valuation to developed markets, it trades at a discount of around 30 to 40%, depending on the measure you look at, which is significant. But is it cheap for a reason, I guess, is always the question here.
Well, the cheap one's obviously China, and the very, very expensive one is India, which is more expensive than the US right now. And that's because the domestic market is really on a roll. People are now starting to invest in mutual funds. It just become a standard thing to do in India. Also, they have restrictions on where they can buy stuff, so they can't invest in global markets. So they are, in a sense, a captive market. But that's been hugely beneficial to their own domestic market as more and more people save into these mutual funds regularly.
I mean, a lot of emerging markets have that dynamic where there's some form of capital controls, either explicit or implicit. Like China's the same thing, right? It's hard for a Chinese citizen to invest outside of China. But you're right about those valuations. So India, on a forward price to earnings basis, is currently at 23.5 times, which, as you say, is a little bit higher than the US. And we know everyone's going, the US is crazily expensive right now. You compare it to China, which is trading at just a 10 times multiple. And that's not even the cheapest. Look at Brazil, 7.7 times.
So if you do buy an ex-China version of EM at the moment, you're going to have something which is expensive in the form of India, and it excludes the really cheap one, which is China. But it does include other ones which are cheap. like Brazil.
And Turkey's even cheaper than Brazil. The cheapest region looks to be Latin America, which is around 8 times as a multiple, whereas Asia is more like 13.
But look, I think it pays to talk about the risks that you take when you invest in EM. And I think policy and the way governments run countries is a big part of that. And also crisis-ridden countries, which just screw up again and again. Then you have to think about things like geopolitical instability, and you realise that you get that premium for a reason, if it exists at all. Because the kind of assumption until quite recently was that if you buy an emerging market index, what you're buying is a kind of gradual process by which countries become like the West. So they become like a mini US or a mini UK.
Well, let's hope the US, right?
You're assuming that they're going through this kind of gradual evolution into us, which is not really what's going to happen at all, I don't think. They're evolving into their own state, which is going to be different from ours, politically, but also in terms of their political alignment.
I mean, I guess the story at a very high level was these countries are going to grow faster than the West. Therefore, shareholders in those countries should capture some of that growth and see higher returns, even if it's a more volatile journey along the way. And it is true that they're growing faster and are expected to grow faster. So the combined share of global GDP for the 10 largest emerging markets has doubled since 2000. So back at the turn of the millennium, those 10 biggest emerging markets were around 13% of global GDP, and now they're more than 30%. However, GDP per capita does remain quite low. So a lot of that growth has come from population expansion. If you look at GDP per capita, and this is in purchasing power parity terms, then emerging markets have around a third of the GDP per capita of advanced economies. However, the growth is expected to be strong, more than 4% per year over the next 10 years, compared with just 1.5% for advanced economies.
And really, I think when you look at growth in emerging markets and how they can become like developed markets, the actual process is one of urbanization. So people move from a largely agricultural economy to one in which many people live in the cities, as we do in the West. And usually that means they earn more money per person than they would if they were working as a labourer in agriculture. However, there's something called the middle income trap, which often affects countries as they go through this process, whereby you go from a low income per person to a kind of middle income, but then taking the next step up to high income as you get in the West is much, much more difficult.
It's really difficult. Arguably, South Korea is one of the few countries that's managed that in the last 50 years.
Yeah, and it's been spectacularly successful in doing that, but it's unusual.
Even China is still a middle-income country, really.
Yeah, absolutely. I think the fundamental problem here is that you need to go from a country which is seen as cheap labour to a country which is seen as the technological innovator, where they have a lot of value add in their exports, and that generates much higher wages for the people who are involved in that industry. So you've got to have highly educated people, and you've got to go from a population which isn't very well educated to one which is. And South Korea has done that very effectively.
I think this is one of the biggest structural risks facing emerging markets right now, is that they could be squeezed in the middle between developed markets and frontier markets. And frontier markets are places which are very much low-income countries, a lot of Africa and developing Asia, where they're not quite advanced enough to be in the EM indices. So I saw that emerging markets are actually experiencing a falling share of global investment in automation. So in 2023, EM imported only 30% of the $12 billion that went into robots and industrial automation. And a lot of that was in China. So in terms of manufacturing, you've got the West, which is rapidly embracing AI and industrial automation, especially in America. Their factory spend has gone way up. And then you've got a lot of frontier markets which are coming online. And this new source of cheap labor for things that aren't going to be automated, EM could find itself a little bit stuck in the middle, maybe.
So I've done a video on India and reasons to invest in India and reasons maybe not to invest. And one of the stats that popped up while I was researching it was the number of STEM graduates per year in India. They have about 2 million STEM graduates every year, which is...
That's too many scientists, too many.
Okay, it's only about 0.15% of their population. And if you look at China, it's about 5 million STEM graduates every year. So, staggering numbers. So if you do look at this innovation, there'll be all these people rolling out of these universities with all this scientific knowledge in their heads. How could you not create an innovative society? All you need is these centres of innovation where you've got capital, you've got a concentration of university graduates, places like Stanford, Berkeley, and that combination of an entrepreneurial spirit and a legal system that doesn't make it too difficult to create a startup. If you've got that combo, then I think you can set up your own kind of Silicon Valley in India or China. But what we've seen so far is that China actually steps in when they become too successful. And it's very difficult to innovate in China, I think, given the political system. India, on the other hand, I think has a much better chance of doing this, given its politics, given its number of graduates now. So I think that's got a lot of upside to that story.
Well, you have seen the success of Indian expats, especially in America, running big tech companies.
Yeah.
So if some of them create big tech companies back home.
That's right. And I think that has happened. You get a lot of people, for example, who work in the biotech industry in America and then head back home to India to set up their own companies to do the same thing or very similar things.
I mean, on a broader point here, demographics is very interesting, isn't it? And that's, again, a thing that's not uniform across emerging markets. But it is true that most EM countries will benefit from a sort of demographic dividend in the coming years, where the old age dependency ratio will only be around 24% in 10 years' time, which is much better than in most of the West. However, there are big exceptions to that. And chief among them is China, which is aging faster than almost any other country.
Yeah, so the three extremes here are Japan, which has got a dependency ratio of 51%. Most European developed markets are between 27 and 39, so the UK and US fall into that category. China's at 21 and rising really fast.
That's the point, it's the path from here.
But India, 10% and rising quite slowly. So that really stands out, I think, compared to other countries. And that's so important when it comes to firstly hiring people to service demand. If you've got a rapidly rising workforce, increasingly educated, that's a big bonus. And when it comes to demand for those goods and services, young people tend to buy that stuff more than old people.
Every time I look at the sort of demographic trends and where we're going to be in the future, I get a little bit panicked about equity market performance. So by 2050, the old age dependency ratio in high income countries is expected to be around 50%, right? Which is incredible. At least in EM, it's only expected to be 35%. And India is obviously a lot better than that. So maybe India is the sweet spot. But then the downside is the Indian valuations are pricing in a lot of growth.
Yeah, I'd be interested to know what the steady state would be for the dependency ratio. If you have a kind of stable population, what does it asymptote to for any country?
Roman, though, there is no steady state. With the fertility rate, below replacement rate at 2.1, it just shrinks every generation until there's no humans left. You extrapolate it forever.
So we're just going to die out, is that what you're saying?
Well, some people do think that, don't they?
Unlikely.
We've done our bit. We've had 2 kids each.
Yeah. We're going to go to Mars and Elon Musk is going to take us there and it'll all be fabulous. We'll all trade cryptocurrency.
He'll take his 50 children there.
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and some of the lowest FX fees on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers can also benefit from the Trading 212 card, which offers 1.5% cash back on all transactions until January the 1st, 2025. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1 and use the promo code ROMIN within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. PIES and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You are responsible for all investment and rebalancing decisions. Free shares can be fractional, terms and fees apply.
Right. In terms of an emerging market fund and the stocks within it, Romin, what is it that actually drives the performance? Is this just a subset of global equity, or is it almost a different asset class to developed market equity?
Well, indirectly, you're buying certain things when you buy emerging markets as they stand today. And a big part of that, if you're a macro investor, is currency, because dollar strength generally is bad for emerging markets. High interest rates in the West, bad for emerging markets. And if that's the case, and it is looking like we're entering an environment where both of those is true, that's not good for EM. And of course, it assumes that you've got free trade, because if free trade starts to slow down, a lot of the sources of wealth for EM are going to be sapped.
On the point of the strength of the dollar, I've got a graph here which maps dollar strength against the relative performance of emerging markets versus developed markets. And those three time periods we mentioned earlier, 95 to 2000, 2000 to 2010, and since 2010, almost perfectly aligns with the dollar strengthening or weakening. So up to 2000, the dollar was strengthening, EM was suffering. After 2000, the dollar was weakening, which was helping EM. And then since 2000, broadly, the dollar's been strengthening and EM's been suffering. Are we just betting on the dollar here?
Well, the first order, yeah. I think that's certainly true.
But why would that be?
Well, there's a bunch of reasons. A lot of the debt that's issued by emerging markets is issued in US dollars. So if the dollar strengthens, the cost of servicing that debt increases. And also, a lot of government debt in emerging markets is issued in the dollar. So that's also a negative impact if the dollar's strong versus their currencies.
And I guess they're also really reliant on trade, which is priced in dollars often.
Exactly. And so that can be a problem. If the dollar does strengthen, that's effectively going to reduce the value of their exports.
What else drives EM performance?
Well, I think generally, if there's growth in the West, there's demand for commodities, and a lot of EM is commodity producing. So generally, if you've got free trade, good global growth, it's going to be good for EM. And if there's high risk appetite, it's going to be good for EM as well. It's when people are scared that they pull their money out of EM. You've had a lot of crises in the past where you get a hard stop, and people who've been ploughing money into EM debt, into EM stocks, immediately pull out their money because they think, well, I'll repatriate it to the West where it's safer.
But what was weird was we had that low interest rate period where it was very much risk on, people were reaching for yield, and yet EM did not benefit from that environment. It hugely underperformed since the financial crisis.
Yeah, I think this has more been a story about outperformance of the US rather than very poor performance of EM. But, maybe it was because people just didn't want to invest in countries which weren't innovative. Maybe it just wasn't an exciting market. But, it's certainly not true that Indian equity has underperformed the rest of the world. In fact, I think it's certainly given the US a run for its money, which is unusual globally.
Yeah, China has weighed down the EM indices. If you excluded China from the EM basket and excluded the US from the developed market basket, things are a lot closer.
Yeah. So there are, exceptional countries which are kind of skewing the results there. It really is showing that EM is a very mixed bag. You're buying countries which are just very different in terms of their drivers and the macroeconomic drivers of their equity market performance.
And the commodity exports, as you mentioned, is a big thing. So a lot of EM countries are net exporters. You look at particularly countries like Qatar and the UAE, where net commodity exports are between 40 and 60% of GDP. So it is their economy, more or less. But then you've also got Saudi Arabia, Peru, Chile. All of those are big commodity exporters. But then you do have EM countries which are net importers of commodities, obviously China, but also places like the Philippines and Thailand.
And if you look at India, for example, more than 80% of its oil is imported. And obviously that's going to be a problem if we have another energy spike. So, you've got one part of EM which is going to massively benefit, which is countries like the UAE, Qatar, and then other countries like India, which are going to hugely suffer if we get an energy spike.
I was looking at some research by Yardeni, and they say that the emerging markets MSCI indices in local currency is highly correlated with the raw industrial spot price index priced in dollars of commodities.
Yeah, there the correlation is just ridiculously high.
But it's interesting that it's in local currency that the indices have that effect. And then you've kind of got a double currency effect, I guess, when we're buying it.
And there are all sorts of spillovers from the West into emerging markets, which cause destabilization, primarily what the Fed does. Because remember, if the Fed raises rates aggressively, EM countries have to respond. And of course, if that means that the debt servicing costs increase in their country, that can be a brake on their economy. And it can even destabilize EM economies. And then we've had a series of EM currency crises, maybe directly, indirectly as a result of that.
What's interesting now, I think, though, is that a lot of EM countries seem less exposed to foreign currency markets. So they have relatively lower sovereign debts than in the West, often below 50% of GDP. They also have built up higher reserve capital buffers at their central banks, I think wary of those currency crises they had in the past.
Yeah.
And I think their central banks, in large part, have become a lot more institutionalized and a bit more independent from central government. And interestingly, and maybe crucially, EM countries are issuing less foreign currency debt than they used to. So it's, I think, below 30% of government debt is now in foreign currencies for those EM sovereigns.
And it is an attractive asset class if you're retired, because you can earn a yield of about 6% if you buy emerging market sovereign bonds. Some of those are hard currency, i.e. issued in dollars. Some of them are local currency, where you're taking a larger currency risk, I'd say. So for retirees, this is definitely an asset class which is interesting for income generation. But you just have to be wary of the risks, which is these sequence of crises that we've had in the past and which will probably happen in the future again.
Well, maybe I'm being complacent, but when I look at the numbers, it seems less likely to happen as frequently going forward. So if you look at the government borrowing figures in these emerging markets, their fiscal position is often better than Western countries. We're just struggling to pay our bills, whereas they seem to have their house in order.
Yeah, maybe that's going to be the story over the next decade, which is that developed market countries are going to run into debt problems and perhaps suffer in terms of economic growth and equity market growth as a result. And then DM will underperform EM in the next decade.
I guess the skeptical part of me looks at the numbers and says, how much debt is off the books, though? Like, we know in China, their total borrowing figures didn't look too bad until they had to include and bail out their local governments. And then the debt position is a lot worse. And the other thing that worries me is that emerging market countries find it much harder to raise tax revenues because there's a big informal economy and more volatility around incomes. And they generally collect a lot less tax as a share of GDP than developed markets do. So EM countries collect an average of 23% of GDP in tax revenues, which is 10 percentage points less than the developed market OECD average. And in some countries, it's really low. So Indonesia is less than 15% as a tax take, and Mexico is like 18%. If they did get into trouble and needed to raise revenues, they'd find it difficult to do so.
And that's why I think policies, structural change policies like demonetization in India, although it was massively unpopular, has actually made it easier to tax people because the informal economy is much smaller. So it's very difficult to do these structural reforms. You get a lot of political unrest when you try to carry them out. But I think it's one process which is necessary in order to make that next step to being able to spend more on infrastructure because you've got more tax revenue. And really, India seems to be heading in the right path there.
They will need a lot of investment, these countries, especially when it comes to the power grid and energy capacity. Because at the moment, electricity demand in EM countries is less than a third of that in OECD countries. There's a really interesting stat I saw in a report from Schroders, which said that average electricity demand per capita in EM is around 3,600 kilowatt hours per year. And if you exclude China, that falls to 2,000 kilowatt hours per year per person, which is roughly the same as running a refrigerator.
But again, I think what's interesting here is that a lot of EM countries are in areas where you've got a lot of sunshine. So I think solar power could really transform those countries. And now that we've got these cheap solar panels coming out of China, there could be a turnaround there in terms of energy production. As long as you can build a grid that can actually use that energy and distribute it.
Yeah, they're going to see a surge in demand, a massive surge in demand for power. As they grow and catch up with the West, more people urbanize and, have more appliances, power demand in EM is set to rise by more than 3% per year until 2040, compared with around 2% in the rest of the world. If you add all that up, EM markets need to power up like an additional Brazil every year for the next 15 years. That's a lot of money they're going to have to spend. We all are going to have to spend a lot of money on the green transition, but will EM be able to fund that? Is the question.
Yeah, in some cases, it's incredible what they've been able to achieve, going from zero technology to the latest technology over a short period of time. So perhaps that'll happen with energy infrastructure as well. Let's hope that's true.
I mean, it's vital for the world that we get a handle on carbon emissions, because climate change is going to have a big effect. We know that. But it's going to have an even bigger effect on a lot of these EM countries because they're in those regions, like you say, where it's sunny and more exposed to climate risk.
And there's a beautiful graph, and maybe we could put this in the newsletter for this week, but it shows you the exposure to the most adverse risks resulting from climate change. And if you look at lower and middle income countries, the amount of GDP which is at risk is massively increased relative to upper and upper middle income countries. And a large proportion of that is due to extreme heat risks and also water stress risks.
Yeah, so this is a graph from S&P Global about how much of annual GDP is at risk by 2050. And it's no surprise, I think, that these countries are more at risk. And if you look at a regional breakdown, South Asia is the one that really stands out, with more than 12% of GDP potentially at risk from, like you say, extreme heat, but also storms, wildfires, coastal floods, river floods. The graph does a good job of breaking it out, and I don't know how accurate those figures are, but intuitively it seems to make sense. I do think we underestimate climate risk.
And then on top of that, you have to consider the geopolitical risks, because often if you have water stress, for example, that creates political conflicts and perhaps even wars. It doesn't sound like water is a very important topic, but certainly it's important for places like China, where a lot of the places where they've industrialized and where people live are not the places where you get a lot of rainfall. So water stress is going to become more of an issue, I think, over time.
As if we needed more things to fight about.
Now, I don't think we could avoid mentioning the fact that with the new administration in the US and with the policy of greater tariffs, that's definitely going to be detrimental for EM. And if we look at which countries have done well during this kind of Trump trade period, when DM has just gone crazy, crypto's gone crazy, many risk assets have rallied, the one exception has been EM in general, because that's seen as the target of the tariffs and is expected to do poorly as a result.
So obviously there's going to be big tariffs on China. There are already, but they're going to get bigger probably. But then also countries like Mexico, which was hoped to benefit from a kind of reshoring and people moving away from China. Oh, let's put the factories in Mexico, which they've done. But now there's going to be tariffs on Mexico probably, which is not great for them.
So they called it friendshoring, but it sounds like it's a temporary friendship.
I don't know if Trump has friends. It's more like transactional acquaintances. So let's wrap this up then. We've talked about a lot of the positives, which is they're going to probably have greater growth in these countries going forward. They've got younger populations, a lot of them. They've got a lot of ability and people that could industrialize their countries at an even faster rate. And they've got some great companies in there as well. So should you buy EM, or are the risks just too great? Should you just stick to developed markets where maybe your money and your capital will be a bit safer and treated a bit better?
Yeah, for my core portfolio, it's developed, right? So I've got no EM there at all. And that's pretty telling. But the reason why I chose that wasn't because I wanted to exclude EM. It was simply because it was the cheapest fund on the Vanguard platform. If I had a choice, I would have included EM for the reasons you're talking about. But at the moment, I just think that the risks for EM, the combination of policies which should strengthen the dollar, tariffs, and also a move towards more isolationism in the US, I think all of those are going to be a problem for EM. So it's still on my market crash shopping list, but I think if I did go for EM, I'd go for ex-China or perhaps a single country index like India, because I think India is probably the one I like best.
Everyone else already likes India as well, though. That's why it's expensive.
Exactly. So that's why I'd wait until there's a pullback, some kind of crisis which pushes down valuations in India, and then I'd choose to buy exposure.
The question is how much, though, isn't it? If you look at the All Country World Index, EM generally is around 10%, give or take, of the index.
Yeah, and as America's done so well, it's kind of squeezed down a bit recently. But I would like to have EM as part of my core. But hopefully Vanguard's going to issue some kind of fund which is global and which is cheaper than their current offerings.
For me, it's already part of my core portfolio because I just buy the world. Maybe I'm not so cheap as you. And I'm willing to pay a few extra basis points for the full world.
Now, we mentioned the newsletter, which we call the Weekly Market Roundup, which takes a light-hearted look at news stories and also economic stories from around the world. It's completely free. It's delivered to your inbox on a Friday evening as soon as we write it. And if you want to learn more about that, just go to our website, pensioncraft.com/newsletter.
Okay, today's dumb question of the week. Is South Korea an emerging market?
Well, it depends who you ask. If you ask FTSE Russell, they think it is part of developed markets, not an EM country. If you ask MSCI, they say that it's not developed, it's an EM country. And it makes a big difference because it's such a large market.
So FTSE Russell reclassified South Korea to be a developed market in 2009, as did S&P, whereas MSCI every year it publishes a report about the different countries in which indices they should be in. South Korea is always in there, and there's always a few things it goes, no, you're still EM. You haven't met this yet.
So let's just go through some of those reasons for exclusion, which MSCI quotes. The first one, which I think is very important actually, is the limited convertibility of the Korean won in the offshore currency market. Now, if you put your money into a country, it's a real problem if you can't get it out. And if you haven't got that full convertibility, that's a big issue. So why don't they change that policy? Is it because they're worried about big outflows? Is it because they're worried that that's going to destabilize their market? But the benefits, I think, here would outweigh the drawbacks.
They are changing it. So from January 2024, registered foreign institutions are now able to participate in the onshore interbank FX market in Korea and engage with direct FX transactions with banks. MSCI is monitoring it to see if this is going to be enough to meet that criteria. We'll see next year. But there's lots of other things they cite. There's some things about market structure and how transactions occur on their exchange. There's things about how they limit data, which makes it hard to create financial products based on the Korean stock market. And significantly, and quite recently, South Korea instituted a ban on short selling, which MSCI says is a big no-no.
That's odd because many developed markets, there's always a political backlash when there's a fall in the equity market and people blame short sellers for that, which is just completely spurious, I think.
Governments often get tempted to ban short selling. But yeah, I agree with you. It's just people placing directional bets. It's nothing nefarious. But anyway, South Korea has a ban on short selling and MSCI says, well, that's not good enough. So what do you think? Do you agree with MSCI or do you think it should be developed like the other index providers say?
I think if you look at the economics of the country, it very much smells like a developed market country. So, just based on that, I think it probably should be in the DM fold.
I know that Jim O'Neill, who was the famous Goldman Sachs analyst, who coined the term BRICS, actually, the Brazil, Russia, India, China thing, he said that regarding South Korea as an emerging market is absolutely ridiculous.
Yeah, I kind of agree with him. I think that it's such a big developed market country, in my opinion, that lumping it with EM countries is ridiculous.
I actually looked at the FTSE Russell reasoning for why they reclassified South Korea as a developed market. And they had technical reasons. But the biggest one, really, was they said, everyone buying our indices expects South Korea to be developed. Therefore, we should make it a developed market because we're trying to provide what people want to buy. And that makes a lot of sense to me. However, I think MSCI were probably a bit smug last week when the South Korean president decided to randomly, out of nowhere, bring in martial law, which lasted about 6 hours. And now there's a political catastrophe in the country. The won is falling, the stock market's falling because the president won't resign. He can't be impeached. Yeah. So, that smells of an emerging market to me.
Yeah, I think there are problems in the political system, like you say. But if we look at the US, for example, and the Capitol riots, you just think, well, you would expect a smooth transition of power in a developed market. So you can't really point the finger and say that's a reason for being EM. But a crazy president, yeah. Should that make you EM or DM?
Yeah, I guess the clue's in the name, isn't it? It's emerging market. It's not really about the country. It's about whether the market and the structure and the liquidity, all of that qualifies it to be a DM or EM country. And I would say that South Korea is not alone on this, on sort of sitting on the border. There are plenty of relatively high income economies which are classed as emerging markets. Taiwan, Saudi Arabia, Qatar, Poland. These are emerging market countries when they're not that different from developed market countries, really, are they?
Yeah.
Even in frontier markets, you've got countries like Iceland, which is a very high income country, but it's not even in EM, let alone DM. All these groupings are a little bit arbitrary, aren't they?
Yeah, but I think you're right. When you buy an index, you have a certain prejudgment about which countries are DM and EM. And if that runs counter to what you're actually buying, well, that's a problem. So I think the index companies do have to provide what people expect.
You still expect UK to be a DM in 10 years' time?
Let's hope so.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.